Hello, my name is Jack Elder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. Today, we are going to talk about U.S. life insurance for foreign nationals. Today's high net worth clients can come from anywhere in the world, and those wealthy families face many of the same challenges and some additional challenges that domestic wealthy families can face. CBS's many years of knowledge and expertise in the foreign national market can help you and your clients acquire US-based life insurance, take advantage of planning opportunities, and avoid planning pitfalls. So let's get into it. Today, we are going to talk about why US life insurance for foreign nationals, what are the tax considerations they face, and what makes our firm demonstrably different. So, as I said at the top, the number of high net worth families is growing worldwide. The pace of high net worth families, in fact, is increasing relative to US high net worth in the international markets. Those families are looking for safety and diversification. US life insurance companies offer, they're highly capitalized. The US currency is highly stable, and the insurance companies are regulated very intensely by the state regulators. These factors make US life insurance very attractive to high net worth international families. US life insurance proceeds and the cash values are denominated in US dollars, which is a huge advantage. The US companies have higher death benefit capacity, and they cost less than our competitors abroad. These wealthy families are also seeking privacy, which life insurance provides. And because they face specific challenges, tax challenges on their US-based assets, life insurance makes sense because of its income and estate tax advantages. So the way I think of it is that the US tax system has a gravitational effect on resident, non-resident aliens, depending on their asset type and the situs of those assets and the client's status. So let me describe what I mean there, and then I'll provide you with an example and a solution to the challenge that foreign nationals face. Okay, so asset type and situs matters. And what I mean by that is if a non-resident alien or a resident alien, or heck, even a domestic family owns real estate, personal property, they have banks and brokerage accounts, stocks and annuities that are US based, even if they live abroad, they're going to be subject to US transfer taxes. There's an interesting exception to this, which provides an opportunity for us on the planning side, and that is that life insurance, a life insurance policy and the proceeds from it, even if they're issued by a US-based life insurance company, the US situs, they could be located in New Jersey, Iowa, Delaware, a US company, the proceeds are not subject to US transfer taxation. So that provides us with a planning opportunity, which I'll get to in a minute. So to sum up about assets, if it's got a US situs, then that gravitational effect, it pulls the assets into the US transfer tax system. The status of the client also plays an important role. The US citizens, resident aliens, non-resident aliens are subject to significantly different tax treatment. So for example, if you're a US citizen, you've got a currently $12 million exemption, you've got portability, but a non-resident alien has a $60,000 exclusion. That doesn't shelter a lot of taxes. If you're a US citizen, transfers between spouses are income tax-free, gives you the opportunity to defer taxes to the second death, and tons of flexibility with our planning. For a non-resident alien, you can defer taxes on income only, not on the principal. And that's if you do it right with a QDOT, a qualified domestic trust. The foreign national only, instead of unlimited marital deduction, they have an annual exclusion. between spouses. So the planning is much harder, and the tax benefits or protections of these exemptions and portability are not available. Let's look at an example that illustrates this challenge and a solution to it. So meet Juan and Irma. They're both age 65. They have a $10 million vacation home in Naples, Florida, and let's assume they have $5 million in a US brokerage account. To illustrate the impact of wealth transfer on this couple, let's assume Juan passes away later this year and that Irma passes away 10 years from now. And that after that, she's going to transfer their US-based wealth to their 2 adult children. So we're going to talk about 2 wealth transfers, one from Juan to Irma and then Irma to her children. Okay, well, if they were US citizens, they would have all the benefits we're typically used to seeing, high exemption levels, marital deduction. They'd have portability, they'd be able to double their exemptions, they'd have all the planning tools at their disposal that US citizens have, but they're non-resident aliens. So what does that mean? It means they don't have the large exemption. They can't transfer wealth between spouses, so they're losing deferral opportunity. So they could defer the income on the wealth that passes from Juan to Irma, but if Irma accesses the principal, or more specifically, if the US-based trustee, which they would need in a QDOT, distributes principal, that trustee would have to withhold estate taxes and remit them to the government, kind of like an employer withholds income taxes. And the $164,000, they would have had to use that proactively each year to transfer wealth. In my experience, that doesn't happen. The family buys the asset and then they enjoy it, but they're not planning for the future. So then on top, after all that lack of ability to plan, Irma passes away in 10 years, and she's only got $60,000 annual exclusion to shelter their wealth. So let's look at this through the prism of numbers. We've got a $10 million vacation home, $5 million brokerage account, total asset $15 million. The asset values, if you assume 4% compounding, will grow to just north of 22 million by the time you reach 2032. So Irma's, if she was a US citizen and they did, let's say, no planning, but there is portability, her exemption, they haven't done any gifting or anything like that. They didn't take advantage of the exemption before the sunset. She'd have $14.5 million exemption sheltering her from the estate tax. Her estate taxes would be $3 million. Well, that $5 million brokerage account, let's assume that also grew, right? And so they'd have $7.5 million liquid. They could pay their estate tax if they wanted straight from there. They'd have the liquidity to do it. Not sure that's the best use of their wealth to pay 100 cents on the dollar. Alternatively, they could allocate 20% of their income each year from that brokerage account, not dipping into principal, just a reallocation of 20% into life insurance to address their estate tax, which would increase their net to heirs by $2.5 million. That would be the path that I would recommend. But in either case, it's manageable. Now let's assume the exact same set of facts, but they're non-resident aliens. Asset values have grown to the same amount. Irma's estate tax exclusion is only $60,000, leaving, unfortunately, her adult children with an $8.8 million bill to the IRS for estate taxes. Well, the brokerage account has grown, right? Isn't that enough to cover that bill? No, unfortunately, it's over $1 million short. So how will they come up with the difference? This is what I mean by gravitational effect. They could liquidate assets in their home country to pay US taxes, right? So now you have the US tax system acting like gravity, pulling in assets from abroad. Well, the family doesn't want that. Alternatively, they could sell the house, but that's not the family plan. So what's their solution? I think you reach the solution by asking a simple question. What percentage of your US-based assets, Juan and Irma, are you willing to use annually to address the inevitable? After educating them on the challenge, how much of your US based assets would you be willing to spend? What I have heard over my career is numbers as high as 5 and 10%. When the reality is it takes less than 1% of their annually of their US based assets to address the inevitable. Let me show you. So if they were to purchase an $8.8 million policy, the level contribution today would be $119,000. To life expectancy, to their joint life expectancy, their contributions would total $2.5 million, which is essentially they're purchasing $8.8 million with a 72% discount, right? The trade is 2.5 over our lifetimes in exchange for 8.8 when we pass away. Pretty good deal just on the economics alone. By the way, if you compare the annual contribution of $119,000 versus an $8.8 million death benefit, they're spending about 1.35% each year for their potential return on an investment. Also, really nice investment. They don't need to dip into any of their principal to address the inevitable. Instead, they just need to allocate 60% of the income generated by their principal. And by the way, where I started the question, what percentage of your net worth would you be willing to use? $119,000 is less than 1% of their US based net worth. So they're really happy. They didn't have to break the bank to meet their goals. They get to keep their house in Naples. Their goals of having the family have access to their vacation home and bring everyone together. They get to maintain that goal, and it's a great investment, the house itself. So returning to their situation, how much of a benefit did this solution provide? Well, their brokerage account grew to what I said, 7.6. Wouldn't grow quite that much if you were allocating 60% of the income to premiums, but you still end up in the red, right? There's been an increase over time. And by the way, that policy could address their estate taxes, leading to a net increase to their adult children of $7.2 million. And I'm not even talking about the non-tax benefits. It provides safety and diversification to the family. They're comfortable because life insurance companies are heavily regulated and heavily capitalized. Cash values and death benefits are denominated in US dollars, which is a stable currency. They could have purchased offshore policies, but it would have costed more, and maybe they couldn't have gotten as much because the US market is really, really attractive to foreign nationals. And oh, by the way, they didn't have to do any fancy planning. No trusts to hold the life insurance, no ILIT, no crummies, no gifts, because life insurance is an intangible personal property asset. Juan and Irma could just own the policy. That's not going to compound their estate tax problem the way it would with a domestic couple. Comprehensive Brokerage Services has the expertise to help you navigate the underwriting, US Nexus, and carrier requirements to get these cases done. We are veterans. We've got a ton of experience. I think this short video demonstrates that we've got we understand the tax considerations. Could talk you through that, talk directly with your clients if you need. If you have international clients, resident aliens or non-resident aliens, they need expert help. We can provide that to you. So if you have clients that meet that description, please give us a call. Here's my contact information. My name, like I said earlier at the top, is Jack Elder with Comprehensive Brokerage Services, and I look forward to working with you.